Hi, I'm Todd Rosenbluth, and welcome to another episode of ETF360. Today I'm joined by Vince Gonzales of Capital Group. Vince, thanks for joining me.
Thanks for having me, Todd. Really appreciate it.
Well, it's my pleasure to have you here. We're talking about Capital Group's short-term income ETF, and I really want to dive into it. So this is the first year that Capital Group has offered ETFs. How's it been going?
Yeah, so we're actually quite happy with how things are going. We launched our first 6 ETF strategies back in February, so on 2/22/22, and we were working really hard to launch on that date. And just recently, this past October, we also launched 3 new fixed income ETFs. So as of today, we're just a little over 9 months from our initial launch. We now have a total of 9 different strategies in our ETF lineup with a little over 5 billion in AUM. So we're quite pleased with that progress so far. And now with our 4 new fixed income ETFs, we're able to provide a highly complementary suite of offerings to our investors for whatever their goals might be in fixed income. So we have a traditional Core Plus bond offering with CGCP, a tax exempt core municipal strategy with CGMU, a higher yielding multi sector income strategy with CGMS, and a short duration income strategy with CGSD. And we're really excited to have this new way for investors to access our fixed income strategies at Capital Group and utilize them as core actively managed building blocks in their portfolio. And the reception from the market so far has been incredibly positive. I mentioned the flows, and it's particularly in what's been a pretty challenging and volatile market. It's really been so far a strong validation that investors are really resonating with being able to access our fixed income strategies in the ETF wrapper.
So let's talk about the benefits of active fixed income. You run one of the funds, as you mentioned, CGSD. What's the benefit of the active approach versus a benchmark orientation?
Yeah, so in fixed income in particular, Todd, active management has proven to consistently add value to portfolios, and it's why actively managed bond funds have been the preferred choice for investors over passive. It's why 80% of all fixed income mutual fund assets are actively managed. Now, contrast that with the ETF universe for fixed income, where only about 13% of assets are actively managed. So we believe this is mainly a supply driven problem so far, where investors actually want to invest in actively managed funds. They just haven't had the opportunity to do so in the ETF wrapper in the same way they've been able to access them in mutual fund form. And we're hoping that we're able to address that with our 4 new fixed income ETFs. And really, the compelling argument about active management and fixed income versus passive to me is that so much of the value add is actually quite structural and repeatable. And we think that becomes even more pronounced in a volatile environment like we're experiencing today. So, take the example of a large corporate bond issuer who needs to raise a bunch of debt to finance a big acquisition. So, they lever up the balance sheet, issue billions of dollars of debt in the investment grade corporate market, and let's say maybe they fall short on their plan to execute on delivering the balance sheet, or even worse, say we hit a recession. So those types of bonds from that particular issue, maybe they're at risk of downgrade, spreads widen materially, and investors lose money. So in a passive fixed income strategy, the fund would be compelled to buy those bonds because of the large footprint in the index. Alternatively, in an actively managed strategy, we can either underweight or actually avoid that particular issuer and be able to shield the investor from a potentially problematic credit position. So this is just one of the many examples of where we feel that active is able to provide consistent value versus passive.
Well, that's great, Vince. So let's dive specifically into CGSD. What are some of the characteristics of the fund?
Yeah, sure. So CGSD is the ticker for the Capital Group Short Duration Income ETF. And we've been really excited to bring this ETF to market because it finally rounds out our short duration bond offerings. It's a strategy that we didn't have in our existing mutual fund lineup, but it's one that we really feel captures a lot of the strengths that we have as a active fixed income manager, particularly given our capabilities and track record in investment grade corporates and securitized credit. The other reason we're really excited about CGSD is because we think it provides a very compelling value proposition to investors. So we're able to provide a combination of quality, diversification, and attractive income with very low interest rate sensitivity. So just to give you an idea, so CGSD currently yields about 6% with less than 2 years of duration. And for folks that know fixed income, to put that into context, CGSD yields about 150 basis points more than the Barclays Ag with significantly less interest rate risk. So we feel that we're able to achieve a 6% profile in CGSD in a very high quality fashion in investment grade rated securities. So this is quite different from other funds you might see in the short duration category that actually have very high allocations to high yield. So, the other thing that we're hearing a lot is folks looking to potentially put money in CDs because they're getting a little more defensive. So let's say you put your money in a 1-year CD that's yielding 4%. Contrast that with CGSD, where you're actually able to earn 200 basis points more in a fashion where you're not having your cash locked up for a year. So we think that CGSD offers a really attractive return opportunity for investors that we just haven't seen for a very long time.
So lastly, Vince, maybe we could just talk about where you're finding opportunities within credit as we're in late 2022.
Yeah, so we're seeing some of the highest credit quality sectors of the short duration fixed income market today now yielding over 5 and in some cases north of 6%, which we think is incredibly attractive. An area that we think offers great opportunities at the front end of the curve is in securitized credit. So one of the most appealing aspects of securitized is that you can access such a diverse range of different credit exposures and construct them in the portfolio. So whether it's deals that are backed by cash flows from auto loans or credit card receivables, commercial real estate, or residential housing, we're able to leverage our world-class securitized research platform to access the areas of the credit markets where we have the most conviction and also avoid the areas where we might have the most concerns. So as an example, one of the highest credit quality sectors in this particular area are deals that are backed by monthly payments from consumers' cell phone payments. So think about that for a little bit. We all need our cell phones, right? And the carriers could very easily shut us off if we don't pay our bills. So this area of the market's quickly become one of the more stable and defensive sources of cash flow. It's the number one payment priority for customers. And so if you think about context for bonds in this sector, so the senior secured AAA rated bonds in this sector are yielding somewhere around 5%. So compare that to where these same types of bonds were trading a little over a year ago, and they were yielding only about 50 basis points. So this is just one of the many examples where we think there's tremendous value being offered to investors in very high quality opportunities in the front end of the fixed income market.
Well, thanks, Vince. Really great insights. I hope people go to the Capital Group website or us at ETF Trends to learn more about the fund. Have a great day.
Thanks so much, Todd. Appreciate it.